Hello everyone, good morning. Today I will be teaching another chapter, Basics of Derivatives, which are basically future forwards and swaps, and then I will be teaching options also. And after this chapter in the evening, I think most probably I will upload a video of equity market as well. Okay, now this chapter is a bit conceptual, so I think it will take a bit of a time. Okay, let's dive into it. What are derivatives? Derivatives are a kind of financial contract between two parties that allows them to lock in the prices of the underlying asset today so that they can execute it in near future. Like, for example, if I want to sell, consider a house for 10 lakh rupees, but I need this house right now and I want to sell it in future, like say after 5 years, but I'm afraid that uh, the price of houses might fall down to 5 lakh. So I'm a bit of afraid. So what I do, I sign a derivative contract with a person who is willing to buy that house at the price of 10 lakhs in future. Now you might ask why that person will buy this at 10 lakh if it can fall down to 5 lakh, because maybe that person is afraid that the price of houses might increase to 12 lakh or 30 lakh, so they also want to fix that price at 10 lakh. So this kind of contract is known as derivative. Now there are four types of derivative contracts: future, forward, swaps, and options. Now some of the basic terminologies are spot price, like at the day of signing the contract, the current market price of that house is known as spot price. Maturity, like the whole time period of the contract. Contract size, self-explanatory it is. Contract value as well. Settlement date, like I think the date of maturity, the date in which the contract will be settled. Some of that, yeah, okay. Now there are four kinds of derivatives, and also derivatives are based on some kind of underlying asset. It can be a house, or it can be stock, equity, or anything. Now there are four kind of broad underlying assets. First is stocks, second is currency, third is commodities, and fourth are interest rates. And the value of the derivative contract is directly proportional to the value of the underlying asset. Okay. Okay, so let's learn about forwards now. The first kind of derivative contracts. These are the customized agreement between the buyer and the seller. They customize the price they want to buy or sell a product in, and it is totally a customized contract. So it is also over the counter, and they are not traded on exchange market, and so they are also not like secured, also not that secured like the ones who are traded on exchange market. They have clearing agencies like SEBI, so they have lower risk. So since they are not traded on exchange markets, they are not that secure in nature, but also at the same time they are very much customized, so they can benefit you more. The counterparty risk is more and liquidity is low, and it is not easily accessible to others, as there are no such platform where the price discovery is available. So that is one thing. And only physical settlement is there. Like for forward this kind of agreement, the only physical settlement of asset is there. And now you might ask, like for currency or interest rate, this can also happen. For that we have, I think, swaps. Yes, swaps are the um, kind of agreement in which they are same like forwards only, just that they occur in interest rate swaps and currency swaps. We will learn about it later. But forwards, uh, this is all customized agreement, over the counter, not traded on exchange, tailor made contract. Counterparty risk is high, liquidity is low, and not accessible to others. Price discovery is not that efficient, and only physical settlement is there. Okay, next is futures. Futures are the contracts which are traded on exchange markets, and they have lower counterparty risks, as there are clearing agencies like SEBI. Liquidity is high and price discovery is very efficient, as everyone can like see it in exchange markets. Or and both cash and physical settlement is there, and it is a standardized contract. You cannot customize it according to your need. This is the most basic difference between forward and future, that forward is customizable, futures are not customizable. They are standardized contracts and they are not over the counter also. Okay, that is all. Now future, like futures can be like there are three kind of parties in futures. They are hedgers, speculators, and arbitrageurs. Hedgers, they are the people who don't want to take that much risk and they are very much risk averse. They want protection against price changes and they want to control the price risk. Speculators are the one who love to take risk. They rely mostly on the risk factor for making profit. Arbitrageurs, they are the ones who exploit the price difference between different markets. For example, a price of same stock right now in NSE might be a bit different from BSE, like very minimal difference. They might want to exploit that price difference, like simultaneous buying and selling of that same stock in different markets will be occurring. So this kind of like this is the process of arbitrage. Okay, next is payoff. Yeah, okay, so basically these are some of the terms. Payoffs are the terms. Yeah, payoffs mean just profit, like the profit in any contract is referred to as payoff. Going long means buying future contract. Going short means selling future contract. So just remember, long means buying and short means selling. Long payoff will mean that buyer is in profit, and short payoff will mean seller is in profit. Yeah. Now, what should happen for buyer to have profit? The buyer who is buying the future contract, for that person to be in profit, the current market price should steadily increase, because in future what happened, if I want to sell the house, I buy the contract. Okay, no, if I want to sell the house, I give the contract, I sell the contract, and the one holding the contract is the buyer, and I will be selling that house to that person as well. This is what happens in future. So if that person wants to have profit, they will want the price of the current market price of the house to go higher, so that they will have a profit by buying it at a lower price. So this is for long payoff, like for profit of buyers in future contract, the CMP should increase. And for profit of seller, like if I am selling the future contract for my profit, the CMP should decrease. uh, that is all. Now, what is cash market or spot market? This is basically the market in which the selling spot price is decided, and yeah, I think the price at which sellers and buyers view the current asset. Now, two types of margins are paid in this. Like in future, two types of margins are paid. First is initial margin, and second is maintenance margin. The first is initial margins, is like a security deposit. It is paid at the starting. Then maintenance margin, it is the amount. It should be kept in the account in case of losses. If the like yeah, okay. Wait, I have to look into this concept. Okay, yeah, see, the two type of margins is like this is basically connected to the trading account of the person who is involved in this buying and selling process. So this is initial margin is the amount of money that person should have in his or her account to initially start the start the trading. This is done so that there is enough money so that the person is able to repay in case of any losses. And maintenance margin is also the amount which should be kept in the account in case of any loss. It should be kept throughout the whole time, and if it goes like the money, if it goes below the maintenance margin, a call is given, um, or the trader is not allowed to continue the trading from that account. Okay, that is all. Now, what is the margin call price? At that is initial purchase price into 1 minus initial margin divided by 1 minus maintenance margin. Okay, below this, the call is given. like maintenance call is given below this. Now, what is the maturity or expiry of futures? The maximum maturity of futures is 3 months. A future contract can be of 1 month, 2 months, or 3 months, and the maturity occurs in the last Thursday of the month. And this rule is given by SEBI. And also regulation of future is like, as future deals with all kind of underlying assets, interest rate, currency, commodities, and stock. The regulation of future for interest rate and currency is done by RBI and SEBI both, and for commodity and stock it is done by SEBI only. Also, pricing of future are like, there are two kinds of people who are like investing in the future contract. One are bullish, one are bearish. Bullish are the people who want the CMP to rise, so mostly they will be the one buying the future contract, and bearish are the one who want the CMP to fall, they will be the one who are selling the future contract. Also, there are two types of model in this case. They are expectancy model and cost of carry model. Expectancy model are the one in which the future price of an asset is like is equal to what the spot price of the asset is expected to be in future. Like, it is simply like, the expected price of like the spot price, like whatever the spot current spot price of the asset it is, what its value will be in future, that is the expected price. But according to cost of carry model, the future price of the asset is basically the current spot price plus the cost of carrying that asset for that time, and then minus the return expected. So this is the future price according to cost of carry model, and I think this one is more realistic in nature. Okay. Okay, also I have skipped I think two graphs here. Yeah, I have to draw it basically. They're very simple graphs, but yeah, for the purpose of remembering. This one, which I was saying that long payoff for profit for buyers, CMP should steadily increase, meaning positive slope. The graph for it is like, consider this the x-axis, and like this is the x-axis and this is the y-axis. The CMP, consider this is your price, then the CMP should increase like this. So, for the long payoff, the person will want the CMP to continuously increase, and similarly for the short payoff, the person will continuously want the CMP to decrease like this. This is it. Yes, now this one was of long payoff, and this one will be for short payoff. Now you can see here that for long payoff the CMP should increase and it will be a profit for buyer. Now this is your strike price. This is no, this is the current. Yeah, this is your strike price and this is your current market price. Strike price means the money you will have to buy the contract in, and this is your current market price. So for long payoff, when the current market price is lesser than the strike price, then it is a loss for the buyer. But if it keeps on increasing, then it becomes a profit for the buyer. So the profit will want so the buyer will want this, and this is kind of a bullish sentiment. And for the short payoff, the seller will be initially happy when the current market price is higher than the strike price, but even no, the seller will be in loss when the current market price is higher. Yeah, seller will be in loss. So, and next, if it current market price starts to fall down, then he will be happy because he will be able to sell it at strike price. And this is the bearish sentiment. Yeah, these are the graph. Okay, now moving on to swaps. So swaps, they are kind of agreement between two parties to exchange cash flows or other financial instrument over a specified time. And as I told you, they have mostly the same features as forwards, and their maturity and duration of contract, everything is similar as forwards. The only difference is in forward, the underlying asset where I think commodities, and in future in swaps, the underlying assets are interest rate and currency swaps. Yeah, currency and interest rate is the underlying asset. Huh. Sorry. Sorry. Yeah, currency, and interest rate is the underlying asset. And in interest rate, a fixed or floating interest rate can be taken into consider for the like yeah. And like it can be, for example, there are two parties, A and B, and party A is afraid that the interest rate for this kind of, like, if they are taking a loan, party A is afraid that the interest rate might rise further than 6%, and party B is afraid that the interest rate may fall further than 6%, then maybe I think party B may not have a fixed interest rate. They maybe has like interest rate might fall further than repo rate plus 2%. Maybe this is their scaling, and the party B might have a fixed interest rate. So they can exchange their interest rate, like party A will pay uh, an interest of 6% at the maturity date, and party B will pay an interest of repo rate plus 2% at the maturity date. So this can happen. Party paying the interest is the buyer, and party receiving it is the seller. Yeah. And currency swaps, they are helpful when foreign companies face hurdles borrowing from Indian banks. This is kind of easy to understand. If any foreign company is facing hurdles in India buying the a specific amount of money, they can contact any other company, Indian company, to take that amount of loan from Indian bank, and that company can give that money to the foreign company. And meanwhile, the foreign company will help the subsidiary branch of Indian company in foreign in the same way. So both will be benefited. Yeah. Now coming to options. Options are for all kind of underlying asset, and they have the features same as forwards. Uh, yeah. No, I think. Wait a minute. Yeah, options have the same features as forwards, just that options, by the name it suggests, it is kind of an option. It is not an obligatory that at maturity you have to complete the contract. You can just say that no, I don't want to go ahead with this contract, and you can pay the premium and back off from the offer. So that is what it is. There are two kinds of option, like call and put option. In call option, it gives the holder, like the buyer, the right to buy or sell. So basically, I am the call option. If I'm buying the call option, then I have the right, if I want to buy or sell the contract. No, I have the right to tell that if I want to continue with the contract, and since I have the buy right, and the seller has the obligation to me, so I will be paying the premium to the seller, and also the I will be in profit when the current market price will be higher than the strike price, because then only I will go ahead with the contract. So yeah. Yeah. And same for put option, I am the uh, in call option, the buyer buys the thing. Okay, that is a big difference. And in put option, the buyer sells the thing. Yeah, sells the thing, and also pays the premium to the seller. And I will be going ahead with the offer only when the CMP is lesser than the strike price, because then only I will want to sell the contract at, sell the thing at the strike price, because the current market price is even lesser, then it will be a profit. And also the profit of seller in both these cases will be the premium only, like the maximum profit of seller will be premium. So now there are four types of possible graphs. One is long payoff, short call payoff, long call payoff, short call payoff, long put payoff, and short put payoff. We will understand each one of this in detail. Just wait. Okay, so these are the graphs. Now consider this is the long call payoff. Long call payoff basically means the call option buyer, like the call option, long means the buyer is in profit. So for the call option buyer to be in profit, the buyer will in call option, the buyer will buy the stuff. So for the buyer to be in profit, the current market price of the thing should be higher than the price he must be buying it, then only he will be in profit. So the current market price is going upwards, and this is the maximum, like um, this is the premium. So like even if current market price doesn't go that high, if he is buying it at strike price only, like even the if the current market price is going very low, then the maximum loss for him will be this premium paid, because then he can just, if it is going even lower than the premium, then he can just pay like the premium and not exercise the, like, and not continue with the contract. Okay. Now in short call payoff, this is the graph. Short call payoff basically means the seller, meaning the short call, the seller of the call option is in profit. Now when will be the seller of call option be in profit? The yeah, the seller of call option will be in profit when the current market price starts to go down. Then he will want to sell the price at sell the commodity, like the asset, at the strike price, because the price is going even, the current market price is going even lower than the strike price, so he will be in profit. This will be his profit, and his maximum loss when the current market price is higher will be this premium. That will be his maximum loss. Okay, so now this is long put payoff. Long put payoff means, put means put option, like long means buyer of the put option will be in profit. When will be the buyer of put option be in profit? The buyer of put option basically sells the commodity, sells the asset. Now, so that person, wait, yeah. So that person will be in profit when the current market price goes lower. Yeah, the current market price goes lower. And wait a minute. Okay, so the buyer of long put will be, like the buyer of put option will be in profit when, because as the buyer of put option sells the underlying asset, then he will want to sell the underlying asset at the specified strike price when the current market price will be going below the strike price. So he will want the CMP to go below, and his maximum loss will be the premium paid. Like in case the CMP doesn't go below, then this will be his maximum price loss, the premium paid. And also the seller of the put option, seller or the writer is also known as the seller, they will be in profit when the CMP goes higher. So if the CMP goes higher, then the seller of the put option will get to buy the asset at the strike price. So they will be in profit. But in most cases, the buyer won't like go on with the contract, and the benefit for them will be the premium paid by the buyer. So yeah, that is all. These are the graphs. And now moving on, from the perspective of holder and buyer, there are three kind of scenarios. In the money, wait, yeah, in the money, out where the buyer is at profit, yeah, and out of the money where the buyer is at loss, and at the money when none of them are at profit. Also, there are two kind of options. So one are American options, one are European options. In American options, the buyer can exercise their right before the date of maturity of the contract, and in European options, the buyer can exercise their right only on the day of maturity. I think earlier in India, American options were there, but now I think European options are considered. I have to look into it. Let us like, this is how the option premium is calculated. It is the sum of intrinsic value and time value of the option. What is time value? Time value is basically like if I want to like exercise my right before the maturity, then it will be calculated like how much time is left in the expiry of the option and how much value it will give with the time. And also the intrinsic value is the, like how much amount the buyer will realize before like, okay, buyer will realize before adjusting for the premium paid. This is basically the difference between the CMP and strike price. So yeah, this is the profit, and it is valid only for in the money options, like when the buyer is at profit, then only it will be valid. So yeah, now these are like the five, I think, yeah, different factors with which a person can, like investor can understand how their option contract will change with time. Now these are delta, theta, gamma, vega, and rho. Now delta is a change in option premium to unit change in price of asset. This basically tells us about the sensitivity of change in options price to a given small change in asset value. And now theta is change in option premium to the change in time to expiry. This tells us the sensitivity of our option contract to the time decay. Gamma is the change in option delta to unit change in asset value. This is basically the, I think, the double derivative of delta. Yeah, yeah, this is the double derivative of delta. Uh, the double derivative of option premium, and it is the derivative of delta. Vega is change in option premium to change in volatility of the asset, like the sensitivity of option price to change in market volatility. Rho is change in option premium to the change in cost of funding the underlying asset. This is basically the sensitivity of option price to the interest rates. So yeah, this was all in this chapter, I think. Thank you.